primary mover of the price of oil right now?
Well, look, I think there's three puts in the market that have been supporting prices around $60 a barrel for Brent, a little lower for WTI. You have a Fed put, which has been triggered with the rate cuts. You have a Saudi put. Saudis have been cutting back supply to try to support a price. And then, of course, there is a Trump put, presumably. I mean, we do think that the president is going to try to smooth out the fluctuations of the trade war and prevent a recession, presumably. So that sets some support to 60. But you have these extreme outcomes in oil of maybe potentially the Chinese retaliating against the U.S. by buying Iranian barrels, or on the other hand, a resolution of the trade war, which could send prices a little higher. So that's where we are right now, around $60 a barrel, chopping around that level with those two tails in sight.
Is that why you remain bullish on the commodity? Because you think Trump, Powell, Saudi will all sort of be there to keep prices from falling too low?
Well, I mean, I think if you look at the fundamentals, we have very little supply. We've lost Venezuelan oil, we've lost Iranian oil, pretty much all of it in the course of the last 18 months. So demand is terrible, don't get me wrong. I mean, that's kind of in line with what's going on a macro basis, but it's just the supply side has been exceptionally poor. We have the highest levels of disruptions in the oil market in 30 years. So that's what's keeping prices where we are.
Is there anything geopolitically that can unravel the production we're contributing here in the U.S.?
Well, I mean, I think the U.S. obviously is slowing down in terms of growth because companies are under a lot of pressure. I'm sure you've been following what's going on with the major equities here in the sector. And so those companies are reining back capital, which is going to slow down production growth. But the real downside risk is that China turns around, and the trade war gets too tense, and we end up with a Chinese government opting to ignore U.S. sanctions on Iran. I think that's a major risk, which would be probably sending the trade war to a whole new level. But certainly we've seen no intention of de-escalating for the time being. I mean, I think there's pressure on both sides to get to a deal, but that's why we're so focused on what's going on in trade.
But the Permian, the production just keeps increasing, and it's not going to stop anytime soon, is it?
Well, that's a U.S. story.
But it's a global story, too, particularly as exports increase.
Well, so the U.S. production growth has been slowing down a little bit on the margin. Remember, the rig count is down by more than 10% since the beginning of the year. And all of this is reflecting a lot of pressure on the sector to deliver dividends and share buybacks. We're talking about share buybacks in the private segment. Energy has to come in and start buying shares back. And that's what the investors are asking companies to do, which eventually will slow down the rate of production growth. But the biggest issue this year is that we've lost Iran. I mean, Iran's the fourth largest producer in the world back 3 years ago. Now they are basically unable to export.
Anything to be made of different commodity, but LNG, which I think hit an all-time global low of 390 an MMBTU on Monday. I mean, we're talking something that used to trade as high as 12 to 15 bucks.
Yeah, I mean, we've seen LNG trading at $21 a barrel in very cold winters in Asia. So there's a couple of things going on. First is that we're at a low point from a seasonal level when it comes to demand. Remember, 90% of the world lives in the northern hemisphere, so everybody wants gas in the winter. LNG is a very volatile commodity in that regard. But the other issue that's been going on is we've expanded exports out of the U.S. pretty dramatically in recent years, also out of Australia. And again, China has basically tariffed U.S. LNG imports. So they're slowing down their imports of LNG. I mean, like I said, this trade war is affecting all commodity markets: copper, aluminum, LNG, soybeans, oil, you name it. There are just different forces at work in each market.
So what about gold? Have you had to raise your target as we've seen
We've raised our target, and there's three things going on in gold. First of all is that rates globally are collapsing, as you know. We have $14 trillion worth of sovereign debt in delivering negative yields, right? So that's naturally pulling people into gold. Second thing that's going on, central banks are very distrustful of each other, and they continue to buy gold for their own reserves. So, and the third thing going on in gold, which is I think is quite interesting as well, is that geopolitical tensions and just the uncertainty of the outcome of these negotiations, not just in trade but everything else, is also drawing investors to be more conservative and increase their gold allocations. So those are the three main factors driving gold prices higher. Some people call it quantitative failure. I just think that's kind of another way to refer to it.
Before you walked in, Reuters had a headline that China was partially easing restrictions on gold imports.
Right.
Is China as important to gold as it is to oil?
It is very important. I mean, there's 1.4 billion people in China that have a lot of money in the bank. China's monetary base is bigger than the U.S. monetary base. If Chinese people take money out of their bank accounts and start buying gold, that's certainly a bullish case. We think gold could be under a level of tensions. We could see gold spiking to $2,000 an ounce over the course of the next 18 months.
Where are we now? 1,509.